Is the Singapore stock market too expensive right now? With the Straits Times Index hitting all-time highs, you might be thinking you've missed the boat. But what if I told you that a deeper look at the numbers reveals a very different story? What if the market might still be reasonably priced? Let's break it down. Welcome to our detailed analysis of the Singapore stock market for September 2025. In this video, we're going to go deep into the market's current valuation, explore the key sectors driving its performance, and discuss the big picture economic trends you really need to be aware of. We'll look at how Singapore stacks up against other global markets and what the key risks are on the horizon. Now, a quick and important reminder. This video is for educational purposes only and is not financial advice. Please always do your own research or consult a licensed financial advisor before making any investment decisions. All right, let's tackle the big question first. Is the Singapore market in a bubble after its record run? The evidence suggests no. In fact, it appears to be fairly valued. Let's start with a key metric called the price to earnings, or PE ratio. You can think of it as a price tag for the market, showing how much you are paying for each dollar of company earnings. Right now, the STI's PE ratio is around 13.6. Now, that number doesn't mean much on its own, but when you compare it to history, it gets interesting. The market's 10-year average PE ratio is closer to 15. This tells us that even with stock prices at a record high, corporate earnings have grown right alongside them, preventing valuations from becoming stretched. We're not paying more for earnings than we have in the past. Another clue is the price to book, or PB ratio, which stands at about 1.36. In simple terms, this means the market's price is just about 36% higher than the stated net asset value of all its companies combined. For a market full of banks and property giants with huge physical assets, this shows that stock prices are still well anchored to real, tangible value. There's no sign of prices detaching from reality here. But the real headline, and perhaps the cornerstone of the investment case for Singapore, is the dividend yield. The Singapore market is currently offering a dividend yield of around 4.5%. Now, to understand why this is so powerful, you have to compare it to the risk-free alternative. The Singapore 10-year government bond yield is much lower, at only about 1.85%. This huge gap between the market's yield and the government bond yield is a massive incentive for investors. It creates what's called a valuation floor for the market. Think about it. If the market were to drop by 10%, the dividend yield would suddenly jump to 5%. If it dropped 20%, the yield would be nearly 5.6%. At those levels, income-seeking investors would likely rush in to buy, putting a brake on any further declines. It's a powerful, built-in support mechanism. So, we know the overall market valuation looks reasonable, but how does it compare to other countries? Let's put it in a global context. Compared to the USA, Singapore looks like a bargain. The S&P 500 in the US is trading at a much higher PE ratio of nearly 26, with a tiny dividend yield of just 1.25%. So Singapore's market is almost half the price on a PE basis and pays a dividend that's more than 3 times higher. Even compared to Japan, which has also had a strong run, Singapore looks attractive. The Nikkei 225 has a PE ratio of over 20, and its dividend yield is low, similar to the Singapore government bond. This places Singapore in a unique spot. It's a high-quality, stable market in Asia that isn't expensive like the US or Japan, but it also doesn't carry the high geopolitical risks you might associate with other markets in the region, like Hong Kong. It offers a balance of value, income, and stability. Now let's switch gears and look at the economic engine behind the market. Singapore's economy has been a tale of two halves in 2025. The first 6 months were surprisingly strong. GDP grew by over 4% in the first and second quarters, which was much better than anyone expected. This strong performance is what fueled the stock market's rally to its all-time high. However, a big reason for this strength was something called front-loading. Businesses were rushing to ship out their exports before new global trade tariffs kicked in. They essentially borrowed growth from the future. Because of this, the outlook for the second half of the year is much more cautious. Growth is expected to slow down significantly as that front-loading effect fades away. On the bright side, inflation in Singapore is very low and stable, at less than 1%. This is fantastic news because it means the Monetary Authority of Singapore, or MAS, doesn't need to raise interest rates. They can keep their policies supportive, creating a calm and predictable environment for investors. This stability is a key advantage, especially when other central banks around the world are still worried about inflation. All right, so we've covered the valuation and the macroeconomy. Now let's dive into the most important part, the specific sectors that make up the market. Averages are useful, but the real opportunities are found in the details. First up, the undisputed kings of the STI, the banks. DBS, UOB, and OCB are the bedrock of the Singapore market, making up almost half of the entire index. They are incredibly resilient. The MAS has run stress tests which confirm the banks have more than enough capital to survive a severe global recession. Valuation-wise, they're still attractive, with PE ratios that are below the market average. And most importantly, they are dividend machines, with yields ranging from 5.2% to over 6.3%. For anyone building a Singapore portfolio, the banks are the essential, high-quality core. Next, let's talk about real estate, specifically S-REITs. This sector presents a really compelling opportunity right now for two reasons: value and income. As a whole, the S-REIT sector is trading at a discount to its net asset value, which is unusual. And their main attraction is, of course, the huge dividend yields, averaging between 6 and 7%. But the really exciting part is their sensitivity to interest rates. S-REITs have been held back by fears of high interest rates, which increases their borrowing costs. But when the global interest rate cycle turns and rates start to come down, S-REITs could benefit in two ways. First, their borrowing costs will fall, which means more profit and potentially higher dividends. Second, as bond yields fall, the high yields from REITs will look even more attractive, likely causing investors to bid up their prices. This creates the potential for both high income now and capital appreciation later. Within the S-REIT space, some areas look particularly strong. Data center REITs, like Keppel DC REIT, are riding the massive long-term wave of AI and cloud computing. And prime retail REITs, like Capital Land Integrated Commercial Trust, are benefiting from the strong recovery in tourism and solid consumer spending. Now, beyond the two giants of banks and REITs, there are other important sectors. The industrial sector offers some targeted growth. Companies like ST Engineering are seeing their order books swell thanks to a recovery in global travel and increased government spending on defense. They offer a nice blend of visible growth and reliable income. And we can't forget telecommunications. A company like Singtel is traditionally seen as a defensive stock, but it's evolving. It's expanding into digital infrastructure, especially data centers, which adds a new long-term growth story to its stable income-paying business. Of course, it's not all smooth sailing. Every market has risks, and it's crucial to be aware of them. The biggest and most obvious risk for Singapore is external, a re-escalation of global trade tensions. The current truce between the US and China is fragile. If a full-blown trade war breaks out with harsh tariffs, Singapore's export-driven economy would be hit hard. This is the #1 threat to watch. The main internal risk is that the economic slowdown in the second half of the year could be sharper than expected. If that happens, corporate earnings could disappoint, which would challenge the market's current high levels. For S-REITs specifically, the risk is that global inflation remains sticky, forcing central banks to keep interest rates higher for longer. This would delay the catalyst for the sector's recovery. So, pulling it all together, what are the key takeaways for September 2025? First, despite hitting all-time highs, the Singapore market appears to be fairly valued, not overvalued. The rally has been supported by solid fundamentals and earnings growth. Second, the main story continues to be income. The market's high and reliable dividend yield is its most attractive feature, providing both a return for investors and a defensive cushion against volatility. Third, The major banks form the resilient, high-yielding core of the market, while the S-REIT sector offers a compelling combination of deep value and even higher income with a potential kicker from future interest rate cuts. In conclusion, the investment case for Singapore is one of quality, value, and sustainable income. It's a market that offers a defensive stability that is hard to find elsewhere, combined with targeted pockets of growth and value. If you found this analysis helpful, please give this video a thumbs up and subscribe to our channel for more updates. Thanks for watching.